afternoon, ladies and gentlemen. Good afternoon, ladies and gentlemen. And it's lovely to have the Rachel Reeves fan club here today as well, so welcome to you all. On a rather dull day in London, hopefully I can bring you some Christmas sunshine in the JPMorgan Global Growth Income PLC Investment Trust. So what is this? Well, it was launched in 1887. I was not alive at its launch, despite what some of you might think. But then it was launched as the British Steamship Investment Trust and had ownership in about 30 steamships. Then in 1900, as interest in steamships dwindled, it moved to becoming invested in railways and shipping. And then after a few iterations, in 1962, it became the United British Securities Trust and had overseas investments. And then more recently, it became the JPMorgan Global Growth Income PLC, or JGGI, and again, transformed its dividend policy. So why am I telling you this? I'm sure you all came here for a history lesson. We've learnt about the London Wall. It's because the trust has adapted to the environment in which it operates. And that is incredibly important nowadays, ladies and gentlemen. I'll talk about some of the companies that we invest in. You need to adapt in how you invest. Companies need to adapt in how they operate. When we're investing in this trust and finding the companies that we like, only the best companies under our coverage make it in. We set a really high bar of companies coming into this portfolio. It's 2.9 billion sterling. That's a little bit more than the £400,000 of share capital when it was launched in 1887. Why is this important to you? Well, bigger investment trusts tend to offer you more liquidity and ability to get in and out when you want to. So size is important. I'll talk about some of the key features. It's a global unconstrained portfolio, but the most important thing, it is the best ideas. We want to find the best companies for you as investors in our trust to own in this portfolio. As I say, it pays a 4% dividend yield, which struck on the 1st of July, at the beginning of its fiscal year, and pays that out quarterly, so you can get an income. But more importantly, we're not sacrificing our investment quality by trying to deliver an income. We're style agnostic, very important, and I'll come to that later on. Now, performance, this is the relative performance. Since the current team took over, 4.2% of annualized trust returns ahead of the index. You're more interested in absolute figures, I'm sure. But I think what's really important is the Morningstar rating, 4 stars. We've also won some awards, and I'd like to do a comparison. I was literally looking at my teenage daughter's school reports last night. It wasn't as bad as I thought they would be, but it's nice to have an independent view of what my children are doing rather than what they tell me. So these awards, I think, are testament to what the investment team have delivered for this company since they took over. And as a result of what the team have done, it's traded a premium to NAV over the last 3 years, a consistent premium. And I'll talk about how we do this in a second. But it's about having breadth of coverage and the resources to really understand the companies that we invest in. Let's talk a little bit about global equities. Here's a chart of the FTSE 100 versus the MSCI All Countries World Index. I'm not trying to have a go at UK equities. I have a huge love for UK equities. I started my time at JPMorgan on the Monday after the UK referendum in 2016 to look after UK equities. Absolute awesome timing. But the bottom line is that global companies, a lot of global companies, have been exposed to some of those trends that really are driving their share prices up. And you'll see a comparison here. If you've invested £100 in June 2014, it'd be worth about 177 if you invest in the FTSE 100, so those large cap quality companies we have in the UK market. But if you've invested in the MSCI All Country World Index, that's £304 returns. That's quite a difference. But we do own UK companies. Has anyone heard of RELX or RELX? Yeah? You've heard of RELX. OK. If you haven't heard of it, you might have heard of Reed International. It was a company that was, I think it was a newsprint company, 150 years or so ago. That company has adapted and changed over time. In fact, have we all heard of Polycell and Crown Paints? Used to own those companies. They don't anymore. In about 1985, they looked at their business model and said, what should we focus on? Then in 1995, Forbes magazine said the internet will kill this company. But the company adapted and changed again. And now, with the benefits of AI, because they've got a huge amount of publications that they own, they're now allowing their consumers and customers of their services to drill down into those publications and find information quicker than ever before. So this company initially, when all this AI euphoria came out, everyone thought it would be a problem for this company because people could use AI to search on the internet and find information, but they own the information that feeds into it. So we do own UK companies. There are UK companies that are benefiting from some of the trends we're seeing today. But global companies, there are some phenomenal companies around the world that are just doing better. And in fact, if you look at the chart on the left-hand side, you'll see the top 50 performing stocks for the 10 years to December 2022. Now, I think you would have been living under a rock if you hadn't realised that US companies have done pretty well over the last few years. But you've also got 24% of companies in that top 50 performing stocks are from Asia, 18% from Europe. It's really important to be globally diversified, particularly with some of the macro news that's coming through. I'm not going to make any political comments, particularly in an audience so wide and varied as we have here today, but obviously we see a lot of leadership changes in governments in the world today. But there's opportunities around the world. Now, I've put 3 companies here. I'm going to go to the other side. I'm quite a large chap and I'm taking up the screen. Who's heard of Microsoft? Okay, some of you. I don't believe that all of you haven't heard of Microsoft. We've all heard of Microsoft, a software company. When I started years ago, 1997, in this industry, you bought CDs for Microsoft Office. Do you remember that? Yeah. And you bought that, and Microsoft, that was yours. Then Microsoft adapted to the changing environment, and you now subscribe to 365. Then they realised the demand for data anywhere in the world. Who's got a mobile phone? None of you. None of you have mobile phones. I don't believe you. But we all want data on the move. We want to access it straight away, immediately. So they moved into data centres. Now we've got AI. My Microsoft Outlook has changed phenomenally. It's writing emails for me, better than I ever could write them myself. That may not be surprising to you after this presentation. But it's adapted and changed. Who's heard of ASML? Yeah, so, oh, that's good. So a company in Europe making wafers for the tech industry. Total monopoly. Now, I can't pronounce it all the time. Photolithography are the machines they're using, they produce, to produce these silicon wafers. Basically getting more processing ability on a wafer that's much smaller. Delivering these to most of the companies, if not all the companies in the world, who are producing chips. Phenomenal company. Keyence. Anyone heard of Keyence? Result. Okay, I have pronounced that correctly. It's not a French firm. It's not Keyence. Keyence. It's a Japanese firm. Testing and automation. That firm has a 350 million year old fossil in its headquarters entrance lobby. I wasn't going to mention death, but I am now, because what they say is if you do not develop products, you die. And through their organisation, they've got different fossils from creatures from times before. A company that consistently adapts the environment it operates. We don't own it anymore because it got too expensive, but we have owned it in the portfolio. That company produces barcode readers. Do we use those in our daily lives? Yeah. Supermarkets. I no longer talk to the person on the till because there isn't one. It's a computer. And you get that reassuring ding when you buy stuff. But most importantly, online retail sales, distribution networks, tracking the items that are coming to your houses, particularly at this time at Christmas. They all have to be tracked, all through barcode readers. That's what this company does. So some phenomenal companies tapped into structural growth themes that we're seeing in the market, but not necessarily US. So don't just think about the US. And how do we do this? We do this because I think we have one of the broadest and most deep research teams in the industry. We cover over 2,500 stocks across the globe. That is our analysts understanding these companies through and through. Our analysts at our organisation spend their whole careers with us. When I joined an asset management firm back in 1997, an analyst role was a stepping stone to becoming a portfolio manager. You don't have to do that within our organisation. And I'll give an example to you. Our insurance analyst was an analyst at our firm for 35 years. He retired. People are allowed to retire. He actually went to school in the building we now occupy. That man spent most of his daylight hours in the same place the whole of his life. I'm not going to make any comments on him. He's a lovely chap. But that's the sort of depth of coverage we have. Our analysts are based in the regions and the countries of the companies under their coverage. You need to culturally understand the management teams so you know how to question them. You know what sort of body language responses you're getting. And as I say, our analysts know these companies after many, many years of covering them. So when a management team takes over a company under our coverage, they can say, 2 management teams ago, they tried this, but they failed. Why do you think you'll be successful? That's an incredibly powerful knowledge to have. We couldn't do it without our analysts, but at the same time, our portfolio managers. They're the ones constructing the portfolios from the coverage that our analysts have. And Helgi, James, and Tim are the 3 portfolio managers named on this investment trust, but they're part of a broader team. And they've got 2 figures underneath each of the names. One is industry experience on the left, and one is the time at JPMorgan on the right. And a lot of these, they match. Because people like working at our firm. We develop individuals. But what you will notice is that numbers are very different. Now, I don't consider myself a dinosaur. You might think otherwise. But when I was growing up, I had 3 channels on television. My children can't believe that. No mobile phones. I had a ZX Spectrum 48K, if anyone remembers that. You had to load games using a cassette player. So my view on the world is very different from Michael Rossi or Sophie, for example. It's different. It's not better. It's different. So bringing through these talented individuals through our organisation, we get different perspectives, diversity of thought. What people like Helgi and James can bring, and Christian can bring, and Tim can bring, is understanding downturns in markets, knowing not to panic, bringing some calm. I remember the dot-com boom and bust. I remember the global financial crisis. I was in Dubai. The place emptied. I remember the European debt crisis. There is another world after these things happen, as we all know. And the experienced individuals bring that calming influence. So what are we looking for? We want to know if there's valuation upside. We don't want to overpay for companies. We want to have a different view from the market. So we want to make sure that we're not overpaying. We might have the same thought that this company can do well, but we want to think it can do better than the market thinks it can do. We don't want to overpay for something. As I say, we want to have an edge. There's no point in us just investing in the market that's going up. We want to find out where there's an edge, where our research analyst has found something that we think the market hasn't appreciated. That's what we want to know. And we've got to have a conviction in the management teams that these companies can do well. And again, the way we're different from the market is really short-term in the view. Do you remember when, dare I say again, the budget came out? The moves in the market that day, particularly in the UK equity market, and what it meant were significant. That quickly changed when everyone starts digesting the information and actually what this meant for businesses, listed businesses in the UK. We have a 3 to 7 year view as to what these companies can do. We want to invest in the best and the best that in 3 to 7 years' time is still around, having weathered any macro conditions that might have caused headwinds for others. The market can have a 6 to 12 month, 18 month view. And they often get it wrong. And the way that we look at the universe is we've got 10 focus groups, essentially. Now, all the stocks in these focus groups are not the same business models, but they are driven by the same structural growth drivers, but not necessarily the same business models. And these will change over time. Currently, we're leaning into high growth and defensives, but these can move around over time, depending on the market backdrop. But essentially what we're building at an overall portfolio level, we want a superior quality of earnings. We want to invest in those companies that have high barriers to entry for competition. And I'll talk about some of those in a second. We want to see faster earnings growth. We want to see companies deliver, not just promise to deliver, but deliver. And as I say, we don't want to overpay for these companies. You can find a lot of good companies, but if the market has already priced it in, what they can achieve, that's not a good investment. So let's take the top 10 overweights. Now, some of these names are very familiar. Amazon. Has everyone heard of Amazon? Thought you might have done. Amazon sold books, didn't they? Do you remember that? Sold books a few years ago. Then they started selling everything. Then they started looking into data centers, I touched on earlier. Now, I don't know whether anyone's had anything recently delivered from other websites using the Amazon courier service. Have you noticed that? I've only noticed that recently. They're now, so some of the packages I've had delivered recently, buying presents for my children, which they don't deserve, has actually come through Amazon delivery services for websites that aren't Amazon. They've diversified their model, but in areas where they're good. They've proven themselves, but they've just looked at the world differently. I've talked about Microsoft, LVMH, Louis Vuitton. I don't shop there regularly. M&S suit, guilty as charged. LVMH, luxury brand. If you go into their store in New Bond Street and you want to go and buy something, you won't be allowed in. Do you know that? You'll go up to someone with an iPad who'll say, I'm sorry, we'll set you a time in about an hour's time. That's how protective they are on the shopping experience for their clients. You either have to book online prior to going there, or you turn up and you're sent away to come back. That's how in demand they are, very protective of their brand. MasterCard, we all know MasterCard. COVID obviously was a great beneficiary for transaction organisations like MasterCard, but a cashless society, online shopping, that company will continue to do well. Southern has just done a deal with Microsoft to provide energy, because all these data centres that Microsoft are producing need energy. So Southern is now providing energy to Microsoft data centres. Some of the greatest companies in the world, but the great thing is, you'll see they're all in different parts of our global focus areas and different parts of the world. Now, I talked about this being a global unconstrained portfolio. It's really important. I cannot style time. My father thinks he can time the market. He was a travel agent. Obviously, he can. I can't style the market, to time the market. And we've had some star rotations recently, but really important because we've got that core approach. You'll see from March 19 to September, well, actually about December 22, January 22, it was a growth market. We delivered 8.1% excess returns. Then we went into a value market. And people say after the events, they saw it happening. They saw it coming. They didn't. And these changes in style can happen very short and sharply. And then we went back into a growth market, but all through these periods, because we're not trying to overexpose ourselves to growth or overexpose ourselves to value, we're able to deliver performance. And this really shows what active management can do. So if you're investing in the MSCI All Country World Index passive fund, you would have got around about 77% returns, less a bit because of fees. But our selectivity, and only about 2.5%, 3% of stocks in our universe get in this portfolio, high barrier to entry for a stock to make it in, enables us to have delivered that 122% versus that 77% for the market. It's active management. Passive investing has a place in portfolios, but active management can deliver this. Now, let's talk about shareholder returns. Since April 2019, since the new team took over, 15.6% annualised returns. That's pretty good, ladies and gentlemen. We have got a statement here, past performance is not a reliable indicator of current and future results. I'm not here to give advice, and I'm not saying we'll continue to deliver that into the future. We'd like to think we can. It's been a very strong run. I will say that some of the markets in the world, the market has overpriced in our view. But we're not tied to one market. We're not tied to two markets. We can look globally for the best opportunities around the world. We have underperformed 2018. Our process tends to struggle when macro factors drive share price returns rather than the fundamentals of the company. We are bottom-up stock pickers. We focus on the company fundamentals. If the market is not listening to those fundamentals and it's driven by macro perception views, what does this mean? We can underperform. But what tends to happen is stock fundamentals reassert themselves. So, ladies and gentlemen, first of all, thank you for your attention. But in conclusion, what we provide in this company is a balanced portfolio of the best ideas we can find out there. From our breadth and depth of research, from our 80-plus analysts covering over 2,500 companies. And we've been doing this for 3 decades. We believe our process works. You then have an investment team who can take all of those insights, set that high barrier to entry to the portfolio, and build this core, unconstrained portfolio of the best companies we can find in the world, but not overpay for it. The trust itself offers this 4% payout target. That's really important. The way that we manage the portfolio, if you're searching for income, you can end up going down the quality spectrum just to find that yield. We're not doing that. We want to have the best companies in this portfolio. And this structure regarding the dividend works best for us. And as I say, strong relative excess returns, but more importantly for you as investors, strong shareholder returns. I'm not saying the world is in a Goldilocks scenario, but I think our process is well placed to navigate any scenario we're presented with. Thank you very much, ladies and gentlemen.